Alright everyone, Cowboy Trades here. Welcome to the channel for an update on the SP 500. Today we're going to be looking at some Elliott wave theory. There are a couple of other charts and technical patterns I do want to talk about, as well as some fear and greed metrics for the stock market. In the past week or so, I've done a lot of extensive analysis, TA, looking at many different things for the stock market. So for this video, just going to be a quick one focusing on Elliott wave theory. Now, let's get rid of the RSI. We'll talk about that in a second. The pattern that I want to talk about today is a continuation pattern that happened all the time in bear markets, and this is a 5-wave triangle pattern. Now, this triangle that's playing out is a bear market symmetrical triangle pattern. If we do come over to elliottwave.net, you can see they call them horizontal triangles. These are correctory waves, and in a bear market, so obviously we're not in a bull market, so we'll come to the right side of this chart over here, and if we come all the way down, you can see this is the pattern that we're currently in, a contracting or symmetrical triangle. I call them symmetrical triangles just to show you how this looks on the SP 500 chart again, and how these work. Obviously, in a bear market, we're not going to talk about the bull market scenario because clearly bear market, but if we are looking at this bear market triangle, you can see this is a continuation pattern that typically breaks to the downside, and these are formed with 5 different waves. So you can see you break down into the triangle and then you break back up and start forming your A wave at the top. You have a lower C wave and a lower E wave, but of course you have your A at the top, B confirming the trend line on the triangle, C confirming the trend line to the upside, D confirming the trend line to the downside, and E is the final point before you start breaking to the downside. So you can see, you know, we established this trend line at A, we established the trend line to the downside at B, we came up for C, this is where this trend line started to come into play. We came down to D. This is where the downtrending, this is where the uptrending line of support in this symmetrical triangle started to finally come into fruition. And you can see right now, we should be pushing up to the top of the triangle for E, which, if we do come back to this chart, this is the final touch point on the triangle before we do break back down lower. And just like you can see on the chart, D should be a higher high from B, and C and E should be lower from A. So if we are looking at this, you can see, you know, you've got a high up here at A, you've got a lower high, you've got a lower high into the downside, you've got B, and you've got a higher high at D. So this is beautifully playing out. You can actually see, just to add some extra Elliott wave theory in this, you can see that we have obviously bearishly broken into this continuation pattern. So you can see a bearish 1, 2, 3, 4, 5-wave market structure to the downside, and since then we've been forming this A, B, C, D, E symmetrical triangle continuation pattern. So that's really the main thing that I did want to highlight. If I do come back to where I was at the start of the video, what's interesting is over on the RSI, you can actually see we formed the exact same pattern. You can see an A, B, C, D, and E right here. Like I said, I'm really not going to focus on too many oscillators in this video because we've been looking at a lot of that on the channel in the past week. So if this is your first time watching my channel, using Elliott waves is definitely not something I use too often, but if you are looking for more extensive analysis, liquidity conditions, technicals, oscillators, moving averages, fear and greed indexes, a much more in-depth perspective, then you can check out the videos that we've been doing in the past week. Like I said, just a quick update on this. Now, if we are looking at the MFI, you can actually see we're not really forming the same triangle pattern because we've actually pushed up above where C would be right here, because the MFI is like the RSI, but it also takes into account liquidity and volume in the market, which if you did watch my most recent video 5 days ago, we talked about how liquidity conditions, book depth, cost to trade are all very overextended right now, indicative that liquidity should come down, cost to trade should come down, longs should be paying funding fees for shorts, bears get the sweeter end of the deal. Liquidity is very overextended right now, and looking at the MFI, we've started to turn down from 78. Like I said, don't want to focus on too much of that. Just wanted to point out this interesting continuation pattern indicating that we should be breaking to the downside very soon. The apex of this pattern is actually on the 28th of February, but typically they do not last until the end of the pattern. Typically, you know, especially after we've come up, according to the Elliott wave theory, once we've really touched the top of the trend line, which we could push up a little bit further on, you can see its potential. The SPX pushes up to 4,065. If we go any higher than that, you would need to be worried if you're a bear, but nonetheless, there is a possibility we push up a little bit higher before breaking down, although it's not necessary. This touch point at A could be enough to send us back down to the downside. Now, coming over to the Dow Jones quickly, we talked a while ago about a diamond bottom formation over here and a diamond bottom formation over here, and we've now broken up to the upside, gone on a big rally for the Dow, and it looks like we're putting in a diamond formation. As we've run into this diamond, this would be indicative that this is a diamond reversal pattern. Just like if we flip the chart onto the inverse scale, you know, you can see that this would be a diamond bottom pattern. But of course, inverse chart, this would be, you know, predictive that we do break back down to the downside. The 2008 Dow fractal, which has been tracking relatively well, is also calling for us to start rolling down to the downside. Bear in mind, you know, we're really just looking at the ebbs and flows in the market on the Dow, and, you know, once again, this is predicting, you know, a rolling over top, which is more or less what we have at this moment in time. The scales are obviously a little bit different to each other. Nonetheless, we should be rolling back down for the Dow Jones very soon. We also talked about this in my most recent video, another traumatizing event, so I won't do too much TA over on the DXY, but you can see the opposite of this diamond top formation. You can see a potential, have to emphasize that this is only on the 4-hour time frame, so I wouldn't really be banking too much on this. Just something I want to point out so you can keep your eyes on, but we do have a potential diamond bottom formation playing out over on the DXY. And if we do come over to the weekly time frame and clear this chart up a bit, you can see, if we look back at, you know, this massive spike that happened in March of 2020, DXY went on a massive run, the equity markets went on a massive tank, crypto markets absolutely tanked. We all know what this was, but this was a huge spike up in terms of the DXY. We obviously broke down underneath that, and then we went on a massive rally, made a cup and handle and blasted to the upside, and never revisited this trend line. So it'd be interesting to see if we do hold this trend line as support. Really keep your eyes for the DXY on 101.9. This is a huge level that you would definitely want to see hold. If you do obviously want the DXY to push up further, there's not really much more room for the DXY to come back down to the downside and still have a good chance of going on another push back up. And just quickly wrapping up on some fear and greed indexes, if we're looking at a summation of the fear and greed, it's currently sitting at 63. Previous close was at 64, so we are currently sitting in greed. We've been looking at this for a while, but, you know, we're about halfway through greed, meaning that we're very close to extreme greed right now. Market momentum, SP 500 and its 125-day moving average, we're basically right above this trend. We're basically right above this trend line in technically neutral, but if we push up much further, this will obviously be pushing us into greed. Stock price strength, the net new 52-week highs and lows for the New York Stock Exchange is currently in extreme greed. For a lot of these definitions, I'm just going to glaze over them or not mention them. So if you do want the definitions, feel free to look to the right and pause the video so you can read, you know, how these metrics are calculated. Stock price breadth, this is in extreme greed. Put and call options, this is currently in greed. Market volatility, this is very interesting. This uses the VIX and its 50-day moving average. This is currently neutral. However, you do have to bear in mind, every single time we've come down to this level, neutral, 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 neutral that we're at right now, the VIX normally takes a huge tear to the upside, and when the volatility index for the S&P 500, also known as the VIX, takes a big move up, it is normally indicative that the S&P 500 takes a big move down. So this being a neutral is actually relatively good for the VIX. This should be meaning VIX should move up very soon, and the S&P 500 should be moving back down. Safe haven demand is in greed. Junk bond demand, this is the only one that's in fear, and, you know, really not too surprising. You know, the markets are still in quite a lot of turmoil right now, so, you know, I can imagine why there's not much interest in junk bonds in the first place. Crypto fear and greed just keeps on pushing up day over day over day. This is currently sitting at 52. So being in neutral is really a sign that momentum is resetting and we should be getting ready for a move back down. But like I said at the start of the video, just wanted to mainly focus on this Elliott wave pattern. This symmetrical triangle is a continuation pattern calling for a move back down to the downside. And if we do come over to the 4-hour time frame, let me give you my price targets. There is a price gap. I believe I have highlighted in another chart, so let me go find this chart. I talked about, okay, it's over on this chart. There is a price gap here, a little bit hard to see on the 4-hour time frame, but if we zoom in, you can see how, you know, we closed down here and then we gapped all the way up here. So we do have a price gap to fill at approximately 3,605, which as of the time of recording is approximately about a 10.25% dump to the downside. That is very, very close to putting us in terms of new lows. You can also see massive, massive bear flag. We broke to the downside of this, formed a lower time frame bear flag, and we're currently residing right at the top of the bear flag and also just underneath the 786 Fibonacci, which we've been having a little bit of trouble with for the past 4 days. So that's really all I've got for you for this video. Like I said, the main takeaway from this was the Elliott wave theory. This pattern that is playing out right now, if I can go over and find it once again, is very, very important. And I'll keep you up to date on how this pans out. But for today, my friends, that's all I've got. If you enjoy the content, let me know down below by leaving a like and a comment. Share the videos with your friends. And if you do want more of my posts, charts, memes, economic data, all that good stuff, more about my personal life, feel free to come over to my Twitter at 618_cowboy. Come and join the Discord. Click on the about on my channel and you can see all of my official links, including the Discord, are down below. But for today, that's all I've got. It's been your boy Cowboy Trades. I'm out. Peace.